No, good afternoon, and I want to try to be optimistic here, but I do got to admit it's just been really a bloodbath in the grain room here the last couple of weeks, and one of the big questions we get is what do we think the lower end of a trading range is going to be, on all three commodities, and that's what we kind of want to hit on here today. So when we look at the corn market, and we have fallen off sharply here, not only the past couple of years, but over the past couple of months. When we take a step back, we just really kind of project a corn maybe trading in a range from 350 to 475. Now, I know everyone's gonna say, well, we're really not gonna go down to 350 a bushel, but if you get back, to the years of 18, 19, and even 20, before we had that late season rally, 350 was visited quite often. And so we have to really respect that. Now, when we take a step back and we look at the world markets in here right now, and we acknowledge the declining production in Brazil and Argentina and potentially Ukraine, we can get some export business. But the week ago's acreage report is just really a black cloud that is overhanging this market. And so rallies above 450 are probably going to be tough to occur. Now, when we get over to the bean side of it, and we don't want to be doom and gloom on beans, but if the world situation is a little more positive for corn or supportive for corn, it's really quite negative on soybeans when we're looking at record carryout forecasted this next year. And then when you look at South American offers for this next spring below $11 a bushel at their port, that really, really overhangs this bean market. So when we take a step back on beans, we're probably looking at more of like a $9 to a 12.50 trading range. The other thing with beans compared to corn is we just think that we're going to go back to our normal 2.5 to 1 ratio. So if you're going to have $4 corn, that means you're going to have $10 beans. Now, as we move over to the wheat market, the one thing where wheat has an advantage over both corn and beans is the big drawdown in world ending carryout levels and the amount of exporting nations out there right now that are going to have available wheat. So we should be able to see a little bit higher floor price on the wheat market. Our best guess for Chicago wheat is $5 to a $7 range. Then the KC would be similar at 5 to 7. With Minneapolis wheat, it should be a bit higher. What you got to remember though with Minneapolis is we are going to be growing those ending carryout levels. This crop up there is off to a great start. And so that's actually probably the weaker link of the three wheat complexes in here right now. Now, as we move ahead, how do we attack these markets? So if we're looking at corn right now and we're saying, look, we kind of think a 350 to 475 range. You look at set futures at 396 and go, well, hey, we're below the halfway point. We should start looking for some areas of support. But when you look at the carry of the market, you got March futures at 422. We think on just a normal market, we can get a 15 to a 30 cent bounce on corn. If we can get that, that'll get Marched 440, maybe 445. Now, if that does occur, that's probably an area where we got to look at selling ahead. Same thing on soybeans. If we're looking at range of 9 to 12.50, you look to March at $11 right now. You know what? We can get a 30 to 50 cent bounce. We probably got to reward this. Similar things down on the wheat market. And that's what makes it very challenging when we see comments out there, well, just sell your crop now and look to reown. You're selling out against a front month contract at a lower price, but buying it so high out on the deferred month contracts. Therefore, we just think a better approach would probably be recognize that carry of the market and say, this is a price that I can live with and make a sale. Now, as we want to wrap things up in here today, we do have a supply demand report coming out on Friday. We have to respect that. We need to remember, though, the last couple of USDA reports have been a bit negative. The other thing you got to keep in mind is the end users are doing all their work in the cash market. If they need corn, they just bid up on basis. Same thing with soybeans, same thing on the wheat side of it. When we're looking at marketing our grain, we got to really look at this carry of the market and potential hedge the carry of futures. Now, if you're in an area where you have a disappointing crop, you probably can expect some basis improvement going on through the winter months. And therefore, if you're hedged on the board compared to a straight cash contract, that gives you a huge advantage compared to making a forward cash sale in here right now. The last thing, and I think this is what we all struggle with, ourselves included, is we can't be afraid of making a small, poor sale. Let's say corn bounces 10 or 15 cents and you make a sale. If we go up another 15, we got to stick with our plan in here right now, realizing that that further push is probably a little bit better for our bottom line. Any questions? Feel free to reach out to us. Have a great day.